Cool. Hi, I'm Ren, and today oh, hey. I'll be chatting about our L2s extractive to Ethereum. So in terms of areas of focus, I want to talk about three main topics. First is around the narrative and also the discussion and discourse in terms of are L2s keeping fees and not paying enough for blobs. The second is are L2s generating ETH activity and new holders of ETH. The third is trying to understand the dynamic between L2s and Ethereum, and I'll talk about some of the scenarios that I think are actually quite likely to happen from more of a game theory type of perspective, but not really discussed too much in the community at the moment. So first, the first popular discourse that everyone kind of loves to talk about and complain about is that L2s are keeping fees and not paying enough for blobs. And if we look at the profit margins for L2s, they've been quite elevated since EIP 4844, with the profit margins going from 20 to 30%, now upwards to nearly 99.5% in some cases. But unpacking some of the underlying dynamics of 4844, blobs are actually still in their cold start period, and what that means is they're pricing at base fee. So David Krappus predicted this cold start problem in March of 2023 using assumptions based off of transaction activity on Arbitrum and Optimism at the time, and that it would take roughly 250 kilobytes per block to get into price discovery. This is roughly 1.8 gigabytes of data per day, and actually we're basically there on average per day, but not yet on a block by block basis. And there have been actually a lot of periods in which blobs have gone into price discovery. This chart shows the blob fee breakdown during the layer 0 airdrop. And you can see for a period of probably around 2 to 3 hours that the vast majority of Ethereum's fees came from blob space. And actually, we are actually pretty much at target. Recently, blobs have been getting really, really close to target. But one of the interesting dynamics that we're seeing is that layer 2s are actually optimizing how often to post and when they post. And I'll dig into this in the next chart. That's why this line looks very suspicious in terms of how it's being pinned against the target. And it never seems to actually cross that target because that would trigger price discovery, which would really hurt the profit margins of the layer 2s. Layer 2s, they do optimize blob posting to avoid price spikes. I think this is really smart. There are actually quite a few startups that are trying to work on this type of problem in terms of the optimization of when to post blobs and how often to sync. So for example, in this example here, you can see that Starknet, which has probably one of the most expensive blob posting procedures, starts to slow down when they're posting to try and dodge these spikes in blob fees. I kind of suspect that we're going to see a lot more of this. And if you think about it from a user experience perspective, whether a layer 2 has posted, let's say, every 12 seconds or every 24 seconds or even every minute, most users, I believe, if you do chat with them, they likely wouldn't really notice the difference. And we're already seeing this behavior. Now, to break it down into a block by block analysis, because in order to trigger price discovery, you do need consistently full blocks. The number of blocks with no blobs is declining, going from more than half of the blocks with no blobs to now only 20 to 30% of the blocks with no blobs. And the unused blob capacity in terms of bytes has also declined from 26% to 13% since summer. No worries. Feel free. I'll share the slides afterwards, so don't worry about taking photos. Generally, overall, blobs inflow per day stands at 2.4 gigs a day. That is above 1.8 gigs per day. That means on average, we are above target. But of course, in order to trigger the price discovery mechanism and to really create burn, we need that to be consistently on a back-to-back, block-by-block basis. The second topic I want to talk about is are L2s generating activity and usage of ETH, the asset, which I think is actually the much more important question. I'm sure everyone has seen this chart already. L2 activity has grown tremendously, and the average TPS on the layer 2s now stands at a scaling factor of probably like 18x. But the L2's usage of ETH as a gas token, which is the main argument that underpins the notion of ETH as money, has actually gone down because, as we know, the layer 1 settlement fees post 4844 have gone to a very low price. And if you plot, I thought this chart was pretty funny. So if you actually take the L2 gas fees, so both of these charts are denominated in ETH. The L2 gas fees include the L1 settlement cost. That would represent the usage of ETH potentially as the notion of money in order to pay for this resource. The L2s are currently a minor contributor to ETH being used as a gas token. So despite the very high activity that we see, I think currently some of the potential discomfort and discourse among the Ethereum community is there was a lot given up, and you can barely see the L2 gas fees compared to even the mainnet activity today. But on the flip side, the good thing is that the L2 usage of ETH as an asset has grown tremendously. So this only shows the canonically bridged ETH, and it's been showing like a great trend over the past 3 years. So in summary, about the current state, one, there's not enough L2 blob demand to consistently get blob space into price discovery. The second point is blob pricing is currently in a bootstrapping period. We know this. We knew this before it shipped. That's where it is today. But we have already seen periods of price discovery, and it's approaching data inflow levels in which I think most likely over the next year, we will see blob fees contribute quite significantly to burn. L2s do drive new usage of ETH as an asset, but from a gas token perspective, that ratio of the amount of transactions that have been moved from the L1 to the L2 relative to the amount of gas given up on mainnet, that ratio, I think, likely needs some calibrating, or potentially the market, or potentially blobs going to price discovery to recalibrate that. The next topic I'm going to talk about is the dynamic between L2s and Ethereum. So this is a great calculator created by Tim Robinson. He made a great post showing the Ethereum blob market. If you took the parameters from the post surge, that would represent 10,000 TPS across the rollups, 16 megs of blobs per block, which would result in a 6.5% yield on ETH, the asset, using reasonable user price sensitivity assumptions. So as the price of gas increases, some portion of the user base switches off and substitutes and stops doing transactions because the cost of doing so probably exceeds their willingness to pay. But I think we're actually here in this like very strange lull period, which is a byproduct of 4844. So pre-4844, the L2 fees were really, really high. Post-4844, the L2 fees are really, really low because blob fees are at min fee. And over the next year, I think we'll likely see a period where the L2 fees will start to creep up again. And I think one of the realities that I think the Ethereum community will have to deal with over the next year is that a few high throughput L2s would very quickly congest blobs before Pectra B. And I think if you flow through user price sensitivities into this calculator, it suggests that the L1 blob space, due to the price discovery, could be the constraint in terms of the L2's ability to get transactions through. So in this simulation, I'm using 5 rollups, 300 TPS per rollup, total TPS of 1.5K. Not super outrageous if you look at the pipeline of L2 projects that are slated to launch in Q4, Q1, Q2, and Q3. And I think the most like worrying thing from this chart is that because Pectra B got delayed until Q4 2025, I think there's a very real possibility that people will start talking about the capacity of the L1's ability to absorb blobs from the L2 as a potential factor for either complaints about high transaction fees, or in the converse, the slowing down of transactions if users are price sensitive. So to answer the question of are L2s extractive, I think the answer today is we don't know. We can speculate, but in reality, we don't know. And the reason for that is threefold. First, L1 settlement fees have never been high enough to test Ethereum's network effect. Two, L2s are relatively new and benefit tremendously from being able to bootstrap their virtual machine tooling, dev tooling, developers, users, assets, community, etc. From Ethereum. And third, I think most of the analysis, including the calculator that Tim Robinson built, they generally assume that you have n equal sized L2s, which one might consider the current state, where you have roughly, not right now, but if you rewinded the clock 2 months, you had roughly 33% share on ARB, 33% share on OP, and maybe like 33% share on base across the three major L2s. But we haven't really spent a lot of time to consider the case where one or two L2s take 80 to 90% of activity and economic value, and the remainder have very marginal economic activity. So things that you might see in that type of situation, if users don't actually mind if the L2s are syncing to the L1 every block, that L2 can do things like very clever batching, slower syncing, that might actually keep the L2 blob fees well below price discovery. And the next thing I want to talk about are some of the hypothetical conditions where L2s could be more extractive. The first is a topic that Vitalik has mentioned, which is the limited capability of an L1 to process transactions. And the reason this is important is because the economic situation of mainnet and L1 becomes riskier, because we did see that for every transaction lost off the L1, the L2s are paying much lower gas fee from the blob settlement. The second is that the L2s do benefit from a highly developed financial ecosystem on the L1. It is important for users to be able to transact on a mainnet that has very different properties than the L2s. Most of the L2s today are running centralized sequencers. There may be some users who may not feel comfortable with that. The second is power law for L2s. The dominant L2 would become the majority blob purchaser, and clever batching could pin blob pricing well below price discovery. Power law is actually the natural outcome, especially for financial networks. Whether you're looking at traditional payment networks, whether you're looking at banks, etc., generally you see that the top one or two or three types of providers capture the vast majority of the market. The third, which we are starting to see, is forms of incentive structures for L2 tokens or non-ETH gas tokens. So for example, you might have a layer 2 that builds their own settlement layer that layer 3s can settle on, which would start to compete more directly with Ethereum. The fourth is any form of escape hatch from mainnet settlement. So you might have some form of new economic staking protocol that is providing some form of like novel security, which would provide an escape hatch from using mainnet to settle against. The next is siloed L2s with their own settlement kingdoms for L3s or similar. I talked a bit about this earlier in terms of the incentive structures for L2s or using non-ETH gas tokens. We are starting to see some very natural behavior where the L2s are realizing that they too can become their own settlement layers with their own ecosystem of rollups that roll down to them. And finally, developing competing security models. So there's a litany of projects on Ethereum that seek to develop competing security models in terms of providing very similar services to rollups and other forms of applications. Cool. So that wraps up my talk. I try to keep it quick. We'll open it up to questions if folks have any.
From my understanding, the main use case of Blob is today taking care of the data availability for layer 2s. However, there are multiple data availability solution providers today in the market, and theoretically or by nature, not only talking about even cheaper price, but also the fact that the price, the ultimate cost of providing or offering data availability, utilizing a third party rather than Ethereum layer 1, ends up with the pricing or the cost model won't be affected by the ETH price fluctuation. Therefore, like when you were saying, you expecting there could be a few layer 2s ends up like with higher performance compared with today's layer 2 has been performed, could better utilize the blob and introduce a price discovery. How you see the other data availability solution provider today in the market to affect the dynamics?
Yeah, I think we're about to see this actually within the next year. When the blobs are full and the price starts to increase and eat into the profit margin of L2s, you don't need outrageous assumptions to congest blobs. And I think what we'll see is, or what I think we'll see is that probably some of the higher throughput L2s won't use Ethereum for DA, and they'll probably use a competing cheaper data provider, because if you believe that the users have some degree of price sensitivity, this price sensitivity is a constraint created by blob congestion on Ethereum. And if it proves out that the vast majority of users are not really thinking about these types of security properties when they're interacting with apps on like a mobile wallet, for instance, I think that is probably what some of the L2s will do. Like the reality of it is they probably will use like an alternative DA solution.